You know what keeps me up at night? It's not the stock market. It's not crypto. It's watching people who've done everything right, saved diligently, invested carefully, followed all the rules, wake up one morning to discover their wealth has evaporated. Not because they made bad decisions, but because the system itself changed the rules while they were sleeping. And here's what nobody's telling you. It's happening right now. Let me paint you a picture. It's 1971. You're holding a dollar bill. That dollar is backed by gold. Real, physical gold sitting in Fort Knox. The government promises you can exchange it. Then, on August 15th, President Nixon goes on television and says those magic words. We're temporarily suspending the convertibility of the dollar into gold. Temporary. That was 54 years ago. That temporary suspension is still in effect today. What happened next? Your dollar lost 98% of its purchasing power. Not overnight. Slowly. Quietly. Like a thief in the night, inflation stole the value right out of your wallet while you were busy living your life. But here's where it gets interesting. While your dollar was losing 98% of its value, gold went from $35 an ounce to over $3,400 today. That's not a coincidence. That's not luck. That's what happens when you hold real money versus paper promises. Now, I want you to think about something. When was the last time you heard a financial advisor tell you to buy insurance? Car insurance, home insurance, life insurance? They'll recommend all of that. But when it comes to insuring your actual wealth against the biggest threat it faces, currency devaluation, suddenly everyone goes quiet. Why is that? Because there's no commission in telling you to buy gold and silver. There's no recurring fee. There's no management charge. You buy it, you own it, and nobody gets a cut every quarter. So instead, they'll sell you on stocks that can drop 40% in a crash, bonds that get destroyed by inflation, and mutual funds with fees that compound against you for decades. Let me tell you what's happening right now that should terrify anyone holding significant wealth in paper assets. Central banks around the world are buying gold at a pace we haven't seen in over 50 years. Not just buying it, hoarding it. The People's Bank of China has been adding to their reserves month after month. Poland just moved 100 tons of gold back from London to Warsaw. Why? Because they want it in their physical possession. Turkey, India, Singapore, they're all doing the same thing. These aren't amateur investors. These are the people who print the money. They understand the system better than anyone, and they're converting their paper into metal as fast as they can. When the people who control the printing press are buying gold, what does that tell you about what they think is coming? Here's what most people don't understand about crisis insurance. Real insurance isn't something you buy after the crisis hits. You can't get fire insurance while your house is burning. You can't get flood insurance while the water's rising. And you can't get wealth insurance after the currency collapse begins. By then, it's too late. The price has already exploded, and you're competing with millions of panicked people trying to get through the same narrow door. Let me give you a real example. Venezuela. 20 years ago, Venezuela was one of the wealthiest countries in South America. They had oil, resources, an educated population. The bolivar was a stable currency. Then the government started printing money to pay for social programs. Slowly at first, then faster and faster. People who held their wealth in bolivars watched it evaporate. 1 million bolivars couldn't buy a loaf of bread. But you know who survived? The people who had converted their wealth into gold and silver years earlier, when everyone else thought they were paranoid. While their neighbors were burning cash for warmth because it was cheaper than buying firewood, these people still had purchasing power. They could still feed their families. They could still preserve their wealth. You might be thinking, that's Venezuela. That could never happen here. Really? Let's look at the numbers. The United States has $36 trillion in debt. That's trillion with a T. The interest on that debt alone is now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We're paying more in interest than we're spending on actual government programs. How do you pay off debt you can never repay? You print money. You inflate it away. You make the debt worth less by making the currency worth less. It's the oldest trick in the government playbook, and it's happening right now. Every time they fire up the printing press, every dollar you hold becomes worth a little bit less. But gold? Gold can't be printed. Silver can't be created out of thin air. There's a finite amount on this planet, and that's exactly why it works as crisis insurance. When governments destroy their currencies, and they always do eventually, precious metals maintain their purchasing power because they can't be manipulated. Let me tell you about the silver market specifically, because this is where things get really interesting. The world uses about 1 billion ounces of silver every year. Industrial demand, solar panels, electronics, medical equipment, electric vehicles, consumes about half of that. But here's the problem. We're only mining about 800 million ounces per year. We're running a deficit. We're consuming more than we're producing. For years, that deficit was covered by above-ground stockpiles. Silver that had been sitting in vaults, accumulated over decades. But those stockpiles are running dry. The COMEX, that's the major commodities exchange in New York, their registered silver inventory has dropped by over 60% in the last few years. We're talking about hundreds of millions of ounces that have simply disappeared from the system. Where did it go? Into industrial use, where it's consumed and never recovered. Into private hands, where people are holding it as insurance. Into countries like China and India, where citizens have been accumulating precious metals for generations because they understand what paper money really is, a promise that can be broken. Now here's where the crisis insurance aspect becomes crystal clear. When a real crisis hits, and I'm talking about a financial crisis, a currency crisis, a geopolitical crisis, what happens to the price of insurance? It skyrockets. Not because the insurance itself changed, but because suddenly everyone realizes they need it. Think about what happened in 2008 during the financial crisis. Gold was around $800 an ounce when Lehman Brothers collapsed. Within 3 years, it hit $1,900. That's a 137% gain while the stock market was in chaos, while real estate was collapsing, while people were losing their homes and their retirement accounts. Or look at what happened during the COVID pandemic. In March of 2020, when the world shut down and governments started printing trillions of dollars, gold was around $1,500 an ounce. Within months, it hit an all-time high above $2,000. Silver went from $14 to nearly $30 in the same period. Why? Because smart money recognized that massive money printing would lead to inflation, and they bought crisis insurance before the crisis fully materialized. But here's what most people miss. The real gains in precious metals don't come from the crisis itself. They come from holding before the crisis, when prices are still reasonable, when you can accumulate without competing with panicked masses. The people who made life-changing wealth from gold didn't buy it at $1,900 in 2011. They bought it at $300 in 2002. They bought it when everyone else thought they were crazy. Let me share something that might surprise you. The average American has less than 5% of their wealth in precious metals. Most have zero. They've got everything in stocks, bonds, real estate, and cash, all paper assets, all dependent on the system continuing to function exactly as it has, all vulnerable to the same systemic risks. Meanwhile, the ultra-wealthy, the people with real money, generational wealth, they typically hold 10 to 20% in precious metals. Some hold even more. Why? Because they understand something fundamental about wealth preservation. Diversification isn't just about spreading your money across different stocks. Real diversification means holding assets that move independently, that aren't all dependent on the same system. When stocks crash, bonds often crash with them. When real estate collapses, it takes the banks down too. Everything in the traditional financial system is interconnected, interdependent. But gold and silver? They exist outside that system. They don't care if the stock market crashes. They don't care if banks fail. In fact, they typically thrive in those exact conditions because people flee to safety. Now, I want to address something important. Some people hear crisis insurance and they think I'm talking about doomsday prepping, about burying gold in the backyard and waiting for society to collapse. That's not what this is about. This is about rational risk management. This is about recognizing that the financial system has vulnerabilities, that currencies have a 100% failure rate throughout history, and that having a portion of your wealth in assets that have maintained value for 5,000 years is simply prudent. Think about it this way. You pay for car insurance every month and you hope you never need it. You pay for home insurance every year and you pray your house never burns down. But you still pay for it, because the cost of not having it when you need it is catastrophic. Precious metals are the same thing, except with one crucial difference. Even if the crisis never comes, you still own an asset that has intrinsic value. Your car insurance expires worthless if you don't use it. Your gold doesn't. Let me tell you about something that's happening right now that almost nobody is talking about. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several others, are actively working to create an alternative to the US dollar for international trade. They're tired of being dependent on a currency controlled by the United States. They're tired of sanctions that can cut them off from the global financial system with the stroke of a pen. And what are they backing their alternative system with? Gold. Physical gold. They're not creating another fiat currency to replace the dollar. They're going back to the oldest form of money humanity has ever known. China alone has been accumulating thousands of tons of gold over the past decade. Russia converted a huge portion of their dollar reserves into gold before the Ukraine situation escalated. They saw what was coming. When a significant portion of global trade shifts away from the dollar, and it's not a question of if, but when, what happens to the value of the dollar? It drops. And when the dollar drops, what happens to everything priced in dollars? Your savings, your retirement account, your purchasing power, all of it erodes, unless you have assets that aren't denominated in dollars, unless you have crisis insurance. Here's another angle most people never consider. The mining industry is in trouble. It costs more to pull gold and silver out of the ground than it did 20 years ago. The easy deposits have been found. The high-grade ore is mostly gone. Now they're processing lower-grade material, going deeper, spending more on energy and labor. Many mining companies are barely profitable at current prices. What happens when it's no longer economically viable to mine precious metals at current prices? Supply drops. But demand keeps growing. Industrial demand for silver is increasing every year as technology advances. Investment demand for gold increases every time there's a crisis or the threat of one. When supply can't meet demand, there's only one thing that can happen. Prices rise, dramatically. And here's the kicker. Unlike stocks, where companies can issue more shares or bonds, where governments can issue more debt or dollars, where central banks can print more currency, you can't just create more gold and silver. It has to be found, mined, refined, and brought to market. That process takes years and massive capital investment. The supply is constrained by physical reality, not by policy decisions. This is why precious metals have been crisis insurance for thousands of years. Ancient Romans used gold and silver. Medieval kingdoms used gold and silver. Every major civilization in human history has recognized these metals as stores of value. Paper currencies come and go. The average lifespan of a fiat currency is only 27 years. But gold and silver endure. Let me paint you another scenario. Imagine you're retired, living on a fixed income. You've got your savings in the bank, your retirement account invested in a balanced portfolio of stocks and bonds. Everything seems fine. Then inflation starts creeping up. Not the official inflation rate, the real inflation you experience when you go to the grocery store, when you pay your utility bills, when you fill up your gas tank. Your fixed income doesn't increase, but your costs do. Every month you can afford a little bit less. Your savings are earning maybe 1 or 2% interest, but real inflation is running at 7, 8, maybe 10%. You're losing purchasing power every single day. Your retirement account might be going up in nominal terms, but in real terms, in terms of what it can actually buy, it's shrinking. Now imagine you had converted 20% of your wealth into precious metals 5 years ago. While your dollar-denominated assets are losing purchasing power, your gold and silver are maintaining it. In fact, they're likely increasing in value as more people recognize what's happening and seek the same protection. That 20% allocation isn't just preserving your wealth, it's potentially growing it while everything else shrinks. This is the power of crisis insurance. It's not about getting rich quick, it's about not getting poor slowly. It's about maintaining your purchasing power when the system is designed to erode it. It's about having a portion of your wealth that can't be inflated away, that can't be confiscated through monetary policy, that can't be destroyed by government mismanagement. Now, let me address something that stops a lot of people from taking action. They look at the current price of gold, over $3,000 an ounce, and they think they've missed the boat. They think it's too expensive now. But here's what they're not considering. Gold isn't expensive or cheap in absolute terms. It's expensive or cheap relative to everything else. When gold was $35 an ounce in 1971, was it cheap? Only if you knew what was coming. When it hit $800 in 1980, people thought it was expensive. Then it dropped back to $250 and stayed there for 20 years. Was it cheap then? Absolutely. But nobody wanted it because there was no crisis, no fear, no urgency. The time to buy crisis insurance is when there's no crisis. When everyone's comfortable. When the market's going up. when people think the good times will last forever. That's when insurance is affordable. That's when you can accumulate without competition. By the time the crisis is obvious to everyone, the price of insurance has already skyrocketed. Think about the people who bought gold in 2002 at $300 an ounce. Everyone thought they were crazy. The stock market was recovering from the dot-com crash. Real estate was booming. Why would anyone buy gold? But those people who bought at $300 watched it go to $1,900 by 2011. They didn't time the market perfectly. They didn't predict the exact crisis. They just recognized that having insurance made sense, and they bought it when it was affordable. Here's something else to consider: the gold to silver ratio. Throughout history, silver has traded at a ratio to gold of somewhere between 15 to 1 and 30 to 1. That means it took 15 to 30 ounces of silver to buy 1 ounce of gold. Right now, that ratio is around 80 to 1. Silver is historically cheap relative to gold. Why does this matter? Because when crisis hits, when people rush to precious metals, silver tends to move faster than gold. It's more volatile, more explosive. In 2011, when gold hit its peak, silver went from $10 to nearly $50 in a matter of months. That's a 500% gain. Gold went up, but silver went parabolic. Is that guaranteed to happen again? Of course not. Nothing in investing is guaranteed, but the fundamentals are even more compelling now than they were then. The supply deficit is worse, industrial demand is higher, above-ground stockpiles are lower, and the monetary situation, the debt, the printing, the instability, is far more precarious than it was back then. Let me tell you what really separates precious metals from every other form of crisis insurance. Liquidity. You can own real estate as a hedge against inflation, but try selling a house in a crisis. It takes months. You need to find a buyer. You pay massive transaction costs. You can own art, collectibles, other hard assets, but the market for those is thin. Finding a buyer at a fair price can be nearly impossible when you need cash quickly. But gold and silver? They're the most liquid hard assets on earth. You can sell them anywhere, anytime. There's always a bid. There's always a market. In a real crisis, when you need to convert wealth into usable currency quickly, precious metals are the only hard asset that gives you that flexibility. You can walk into any coin shop, any dealer, any pawn shop even, and convert metal to cash within minutes. This liquidity is crucial because crises don't wait for convenient timing. They don't give you 6 months to sell your rental property or find a buyer for your collectibles. They hit fast, and you need assets you can mobilize immediately. That's what makes precious metals the ultimate crisis insurance. They combine the stability of hard assets with the liquidity of financial assets. Now, I want to talk about something that might make you uncomfortable, but it's important. Counterparty risk. Every financial asset you own, stocks, bonds, bank deposits, even the cash in your wallet, depends on someone else fulfilling their promise. Your stock is worth something because the company continues to operate. Your bond is worth something because the issuer continues to pay. Your bank deposit is worth something because the bank remains solvent. But what happens when the counterparty fails? When the company goes bankrupt? When the government defaults? When the bank collapses? Your asset becomes worthless, or worth pennies on the dollar. You're an unsecured creditor standing in line with everyone else, hoping to recover something from the wreckage. Physical gold and silver have no counterparty risk. When you hold a gold coin in your hand, its value doesn't depend on any institution remaining solvent. It doesn't depend on any government honoring its promises. It doesn't depend on any company continuing to operate. The metal itself is the asset. There's no promise to fulfill, no obligation to honor. It just is. This is why, throughout history, when empires collapse and currencies fail, gold and silver remain valuable. They don't need the system to survive. They exist independent of the system. And in a world where the system is increasingly fragile, where debt levels are unsustainable, where central banks are trapped between inflation and recession, having assets with no counterparty risk isn't paranoid. It's prudent. Let me share one more thing that keeps me up at night. The derivatives market. There are over $1 quadrillion in derivatives outstanding globally. That's $1,000 trillion. These are complex financial instruments that derive their value from other assets. They're interconnected, leveraged, and opaque. Most people have no idea they exist, let alone understand the systemic risk they represent. In 2008, it was derivatives, specifically mortgage-backed securities and credit default swaps, that nearly brought down the entire global financial system. The government had to step in with trillions in bailouts to prevent complete collapse. And here's the thing. The derivatives market is bigger now than it was then. The leverage is higher. The interconnections are more complex. The next crisis, when it comes, could make 2008 look like a warm-up. When that happens, not if, but when, what do you think happens to paper assets? What happens to stocks when the financial system seizes up? What happens to bonds when governments are forced to print money to prevent collapse? What happens to your bank deposits when banks are failing and the FDIC insurance fund is overwhelmed? This is why precious metals are the ultimate crisis insurance. They exist outside the financial system. They're not someone else's liability. They can't be printed, inflated, or defaulted on. When the system breaks, and all systems eventually break, gold and silver continue to function as money, as stores of value, as crisis insurance that actually pays out when you need it most. I want to be clear about something. I'm not saying you should put all your wealth into precious metals. That would be just as foolish as putting all your wealth into any single asset class. What I'm saying is that having zero exposure to precious metals in today's environment is a massive, uncompensated risk. It's like driving without insurance, living without fire insurance, going through life without any safety net. The question isn't whether you can afford to buy precious metals. The question is whether you can afford not to. Because when the crisis comes, when inflation accelerates, when currencies collapse, when the financial system seizes up, the price of insurance will be 10 times, 20 times, 50 times higher than it is today. And at that point, you won't be buying insurance. You'll be paying panic premiums to protect wealth that's already eroding. The smart money isn't waiting. Central banks aren't waiting. The ultra-wealthy aren't waiting. They're accumulating now while prices are still reasonable, while supply is still available, while they can build positions without moving the market. They understand that crisis insurance is worthless if you buy it during the crisis. So here's what I want you to think about. Not whether precious metals will go up or down next week, next month, or next year. That's speculation. And speculation isn't insurance. Think about what happens to your wealth if the system continues on its current trajectory. Think about what 36 trillion in debt means. Think about what happens when the dollar loses its reserve currency status. Think about what happens when the next crisis hits and the government's only solution is to print more money. And then ask yourself, do I have insurance against that? Do I have assets that will maintain their value when paper assets fail? Do I have wealth stored in a form that survived every crisis, every collapse, every currency failure in human history? Because that's what precious metals are. They're not a get-rich-quick scheme. They're not a speculation. They're insurance, the best crisis insurance on earth. And the time to buy insurance is before you need it, not after the fire has already started.